There's a theory going viral claiming the US government has a plan to erase $38 trillion in debt by 2027 through deliberate currency devaluation. The claim is that they'll destroy the dollar's value, wipe out the debt, and ordinary people will pay the price while the government escapes its obligations. If this were true, it would be the largest wealth transfer in history. Your savings, your purchasing power, your retirement, all evaporated to solve a government debt problem. So I spent the last week investigating. I read economic history. I analyzed Federal Reserve policy. I consulted with economists. And what I found is way more nuanced than either this is definitely happening or this is complete nonsense. Stay with me. Here's why this theory resonates. America's debt just hit $38 trillion. That's $288,000 per household. Interest payments alone cost over $1 trillion annually, more than we spend on defense. At current growth rates, we'll hit $39 trillion by March 2026. So the question everyone's asking is, how does this end? How do you possibly pay back $38 trillion? And that's where the devaluation theory comes in. The claim is simple. Throughout history, governments facing unpayable debt have chosen the same solution. Inflate the currency, make the money worth less, pay back debt with devalued dollars. Problem solved for the government, disaster for everyone holding those dollars. Roman emperors did it by mixing cheap metals into silver coins. Weimar Germany did it by printing money until the currency collapsed. Modern examples include Argentina, Venezuela, Zimbabwe. The pattern exists. The question is America following it? And specifically, is there a plan to do this by 2027? Let's investigate this claim piece by piece. No panic, no dismissal. Just evidence and what it actually means. First, let me present the theory fairly. Because there are legitimate economic concepts underlying this claim, even if the specific prediction is questionable. The theory goes like this. The US government owes $38 trillion. This debt is growing by about $2 trillion per year. At some point, it becomes mathematically impossible to service this debt through traditional means like taxation or spending cuts. So governments have historically chosen a different path, currency devaluation. Here's how it works in theory. If you owe $100,000 today, and through inflation the dollar loses half its value, you still owe $100,000 nominally. But in real purchasing power terms, you only owe $50,000. The debt hasn't gone away on paper, but it's been cut in half in real terms. You've effectively defaulted without officially defaulting. The theory claims this benefits the government enormously. They get to keep borrowing. They get to avoid politically painful spending cuts or tax increases, and they transfer the cost to anyone holding dollars, savers, retirees, anyone on a fixed income, foreign creditors. It's described as a hidden tax, legal theft, wealth transfer from creditors to debtors. Now, where does 2027 specifically come from? Different versions of this theory point to various factors. Some cite Federal Reserve policy timelines. Some point to debt ceiling deadlines. Some reference historical patterns where debt to GDP ratios above a certain threshold trigger currency crises. The specificity varies, but the core claim remains. Major currency devaluation is coming soon, possibly by 2027, and it's the government's plan to deal with unpayable debt. That's the theory. Now let's look at what's actually happening and what economists say about this. Let's start with what's documented fact versus what's speculation. Because some elements of this theory are based on real economic principles. Others are connecting dots that may not actually connect. Fact number one. U.S. debt is indeed $38 trillion as of November 2025. Debt held by the public is $30 trillion. This is from Treasury data. It's growing by about 5.97 billion per day. These are real numbers. Fact number two. Interest costs are massive and growing. Net interest payments are projected to be 13.85% of all federal spending in 2026, climbing to over 14% by 2028. We're paying over $1 trillion annually just in interest. That's real and documented. Fact number three. Currency devaluation has been used historically to reduce debt burdens. This isn't conspiracy theory. It's economic history. When governments face unsustainable debt, they often inflate their way out of it. The academic literature on this is extensive. Carmen Reinhart and Kenneth Rogoff's work documents centuries of this pattern. Fact number four. Inflation does transfer wealth from savers to debtors. When the currency loses value, people holding cash or fixed income assets lose purchasing power. People owing fixed debts benefit because they repay with devalued currency. This is standard economics, not controversial. So those elements are true. The U.S. has massive debt. The costs are real. Historical precedent exists. The mechanism works as described. But does that mean there's a specific plan to deliberately devalue the currency by 2027? That's where fact ends and speculation begins. Here's what's not documented. There is no Federal Reserve memo saying we plan to devalue the currency to erase debt by 2027. There's no Treasury policy document outlining a debt elimination strategy through inflation. There's no congressional hearing where officials discuss this as policy. And what we have instead is people observing high debt, understanding the historical pattern, and concluding that, therefore, it must be happening now. That's inference, not evidence. And it's important to distinguish between those. Let me show you what current Fed policy actually says. According to the most recent Federal Open Market Committee minutes, the Fed maintains the federal funds rate at 4.5 to 4.75%, a restrictive level intended to ensure inflation returns to the 2% target. That's their stated goal, 2% inflation. Not hyperinflation, not currency collapse, 2%. Now, you might say, they wouldn't announce a devaluation plan publicly. Fair point. But if there were a deliberate devaluation strategy, we'd see certain signals in bond markets, foreign exchange reserves, Fed balance sheet behavior, and capital flows. So let's look at those indicators. If the government were deliberately planning major currency devaluation, what would we expect to see? And do we actually see those things? Signal 1. We'd expect to see the Fed massively expanding the money supply. This is how devaluations happen. Print more currency, make each dollar worth less. So is that happening? The Fed's balance sheet, as of late 2025, has actually been shrinking through quantitative tightening, not expanding. They're removing money from the system, not adding it. That's the opposite of what you'd do for deliberate devaluation. Signal 2, we'd expect to see bond markets panicking. If investors believed a major devaluation was coming, they'd dump Treasury bonds immediately. Why hold bonds denominated in dollars if those dollars are about to collapse in value? So are bond markets panicking? According to recent Treasury auction data, the bid-to-cover ratio for 10-year notes is 2.35. For 30-year bonds, it's 2.27. Ratios above 2 indicate strong demand. The bond market is not panicking. Signal 3. We'd expect to see foreign creditors fleeing. China, Japan, and other major holders of U.S. debt would be selling massively if they thought devaluation was imminent. Are they? Foreign holdings of U.S. Treasuries remain stable. There's no mass exodus. Some fluctuation, yes, but no panic selling. Signal 4. We'd expect to see the dollar collapsing against other currencies. If devaluation were underway, the dollar would be weakening rapidly. Is it? The dollar index in late 2025 remains relatively strong compared to historical averages. It's not collapsing. So the market signals you'd expect from imminent deliberate devaluation? They're not there. Markets behave as if they believe in eventual fiscal adjustment, yes, but imminent currency collapse by 2027? The evidence doesn't support that. Now here's where it gets more nuanced. Just because there's no deliberate plan doesn't mean inflation won't happen. There's a difference between intentional policy and inevitable consequence. Let me explain what I mean. Governments often end up inflating away debt not because they planned it, but because they ran out of better options. They keep borrowing. They keep spending. They avoid difficult choices. And eventually, the only politically feasible path becomes accepting higher inflation. It's not a conspiracy, it's the path of least resistance. So, could inflation increase over the next few years, reducing the real value of debt? Absolutely possible. Is it certain to happen by a specific date like 2027? No economic forecast has that level of precision. And is it a deliberate wealth transfer plot? Or is it the messy consequence of decades of fiscal irresponsibility? Probably the latter. Let's look at what mainstream economists say about debt sustainability and inflation risks. Because there are serious concerns. They're just more nuanced than deliberate devaluation by 2027. According to the Congressional Budget Office, debt held by the public is projected to rise from 99% of GDP in 2025 to higher levels unless policies change. That's concerning. The CBO has repeatedly warned about fiscal sustainability, but here's what they don't say. They don't predict hyperinflation. They don't predict currency collapse. They predict gradually worsening fiscal conditions that will eventually require policy changes. Those changes could include spending cuts, tax increases, modest inflation, or some combination. The Committee for a Responsible Federal Budget, a nonpartisan fiscal watchdog, describes the current situation as bleak, but talks about solutions like budgetary reform, not inevitable devaluation. Their focus is on policy choices we still have, not predetermined disaster. What about inflation specifically? The Federal Reserve's long-term inflation target remains 2%. Now you might think that's meaningless if they're secretly planning higher inflation. But here's the thing. Central bank credibility depends on meeting stated targets. If they abandon that target without explanation, they destroy trust, which makes future monetary policy impossible. That's why central banks guard their credibility fiercely. Could there be periods where inflation exceeds 2%? Yes. We just experienced that in 2022 to 2023. But temporary spikes are different from sustained high inflation or hyperinflation. The Fed raised rates aggressively to combat that inflation. That's not the behavior of a central bank trying to devalue the currency. Historical examples also provide context. After World War II, the US had debt to GDP ratios even higher than today, around 120%. How did we reduce it? Primarily through economic growth, not inflation. From 1946 to 1974, real GDP growth averaged about 4% annually. That growth reduced the debt to GDP ratio to around 30% by the 1970s. So there's precedent for growing out of debt rather than inflating it away. That said, there is a legitimate concern that modern economic growth rates are slower than post-war rates. If we can't grow as fast, reducing debt through growth becomes harder. That increases the temptation to use inflation. So the risk exists. It's just not certain, and definitely not on a specific timeline. So where does this leave us? Is the debt reset theory real or hype? My assessment after investigating is that it's based on real economic concerns, but exaggerates the certainty and timeline. Will the U.S. experience some inflation over the coming years? Probably. Is there a secret plan to deliberately destroy the dollar by 2027? No evidence supports that. Here's a more realistic scenario. The U.S. will continue running deficits. Debt will keep growing. Eventually, this will force policy changes. Those changes might include accepting modestly higher inflation, say 3 to 4% instead of 2%, as part of a broader adjustment. This would gradually reduce the real value of debt while not destroying the currency. Is that fair to savers and retirees? No. Is it a massive wealth transfer? To some degree, yes, but it's also the likely consequence of decades of political decisions by both parties to spend more than we tax. It's not a conspiracy. It's a predictable outcome of unsustainable fiscal policy. So what should you actually do with this information? First, understand that protecting against moderate inflation is different from preparing for hyperinflation or currency collapse. The former is prudent financial planning. The latter is based on fear that may not materialize. For moderate inflation protection, standard advice applies. Diversify your assets. Don't keep everything in cash. Consider some allocation to real assets like real estate, stocks that can adjust prices with inflation, or commodities. Treasury inflation-protected securities exist specifically for this purpose. These are boring, standard recommendations, not dramatic prepositio moves. Second, be skeptical of anyone selling you solutions to imminent disaster by specific dates. If someone's telling you the dollar will collapse by 2027 and they conveniently have gold or crypto or survival supplies to sell you, that's a red flag. Legitimate financial advisors discuss risk management, not date-specific catastrophe. Third, understand that being concerned about long-term fiscal sustainability is reasonable. Being panicked about secret government plots is not. The U.S. fiscal situation is serious. It's not a secret. It's discussed openly in CBO reports, Fed testimonies, and congressional hearings. The lack of action is frustrating, but it's political dysfunction, not conspiracy. Fourth, remember that predictions about complex economic systems years in advance are inherently uncertain. Nobody knows exactly how this plays out. Anyone claiming certainty is either lying or deluded. What we can do is understand risks, prepare reasonably, and avoid panic-driven decisions. So let's recap everything. The viral theory claims the U.S. will deliberately erase $38 trillion in debt through currency devaluation by 2027. I investigated this claim from multiple angles. What's true? The debt is massive and growing. Interest costs are enormous. Historical precedent exists for governments inflating away debt. The mechanism works as described. These are real concerns. What's speculation? That there's a specific secret plan, that it's targeted for 2027, that it will be catastrophic hyperinflation rather than gradual adjustment, that markets aren't already pricing this in. No evidence supports these specific claims. What's most likely? Continued fiscal challenges force gradual policy adjustments over the next decade, possibly including modestly higher inflation as one component of debt management. Not a dramatic reset, not currency collapse, just messy, politically difficult adjustments that unfold slowly. Should you be concerned? About long-term fiscal sustainability and inflation risk? Yes. About imminent dollar collapse by a specific date? No. Should you take action? Reasonable diversification and inflation protection? Yes. Panic-driven extreme measures? No. The truth about complex economic situations is usually boring. It's gradual. It's political. It involves trade-offs. It doesn't have villains or heroes or dramatic reset dates. It's just the messy consequence of decades of difficult-to-change incentives and political decisions. Understanding that is more valuable than any conspiracy theory, because it lets you prepare rationally instead of reacting emotionally. It lets you distinguish between serious analysis and fear-mongering, and it helps you make informed decisions rather than panic-driven ones. If this investigation helped you think more clearly about this topic, let me know in the comments. And if there are other viral financial theories you want me to investigate like this, drop those too. I read the actual data, so you don't have to, and I separate legitimate concerns from exaggerated claims. Subscribe for more of these evidence-based investigations. Thanks for watching. See you in the next one.